Hey everyone, this is Ryan Mallory for SharePlanner.com. Today is November 7th, 2013. And we got Twitter's IPO coming out. I guess it came out at like $46, $47 a share today, and now it's, sort of hanging around that price level. The initial IPO price was $26, so I guess there's like a $20 premium on that. There's really not a lot to say about Twitter. I mean, I'm a technical analyst. I read charts, and there's not much of a chart there. So I'll get into that in a second. Okay, I won't dig into that right now. But I guess, you know what, since Twitter's like in the air, we'll go ahead and make this whole video about social media stocks. Okay, Facebook, Groupon, LinkedIn, and of course Twitter. First off, I actually just jumped into Tesla, and I got into it yesterday. We'll talk about this here because there was some activity with this stock. So we got into it at the 100-day moving average, or a little bit right off of it, like at 152 and change, and then it gaps down to 144, and we get stopped out at the open today. Now, I don't like to get back into stocks that I just lost money in. I mean, it's not that I don't do it, because what I'm getting ready to tell you is that I did get back into Tesla. I got back in at around 142.19. And we're actually down on that a little bit right now as well. That doesn't bother me so much to get back in. Well, what I should say is it's not a bad thing to get back into a stock that you just lost money on. Human emotions would dictate that it's not something that we're naturally inclined to do. However, if the setup is there, I don't care if the letters are TSLA, TWTR, FB, KKD, LINTA, LEC, GES. I don't care what the letters are, because really at the end of the day, I'm trading off of charts, and the letters are basically the symbol that gets you to trade that chart. So if you're a technical analyst, you're trading charts, not symbols. Okay, not companies. You're trading charts. And so the Tesla chart, okay, we got stopped out at it this morning, but guess what? There's a good setup there right now, and it's holding true right now, even if we're a little bit underwater on it right now. You have this inverse head and shoulders. I mean, it's like a perfect little thing here. You got the left shoulder, the head, and the right shoulder. So what's the inverse head and shoulders? It's basically the opposite of a head and shoulders pattern, which is like basically looks like a human. You have a left shoulder, a head, and then you have a right shoulder. And so it flip backwards, this is what you got. And that's a bullish pattern, okay? And it's a good sign that Tesla, listen, they didn't have a bad earnings report. People just didn't want to buy the stock, essentially, and they dropped like a rock, and that happens. All earnings reports don't have to be bad in order for the stock to sell off, and that's what a lot of people don't get sometimes. But nonetheless, though, we tried to play it off of this 100-day moving average. That didn't work, and now we're getting an IHNS pattern, which I actually consider a little bit better, especially since that the head of it peaked right at this support 2 pivot point, which could be that this S2 level is the bottom going into Tesla. Because before we know it, people will buy the stock back up. There's too many followers, too many people have made money off of it for them to say, you know what, I'm washing my hands of it, I'm never buying it again, because they will buy it again, I guarantee you. Just like Apple, when it dips far enough, people buy it. And so, fresh off of hitting new highs, it goes from like in the 170s, 180s, all the way down to 140. So I'd be hard-pressed to think that buyers won't eventually step it up here and buy some of this stock. So that's Tesla. S&P, right? Let's go to S&P. All right, so there's this like a hidden support level basically that I'm following. I know I got a lot of lines on there. One thing I could probably work on getting rid of these grids, because I don't really use these grid lines, and I'd be happy not to have them. So it would make the chart probably a little clearer, no doubt about that. But anyways, we did break below the 10-day moving average, which is something we haven't done since, I think it's 10-9, 10-10, yeah, 10-9 we were trading below it. So that's the first time in about a month that we've been trading below this 10-day moving average. Okay, that's not the worst thing in the world. It's the line in the sand for me to where I would start adding new shorts to my portfolio. I don't have any shorts in there right now, but if I were to start adding shorts, it would need to break below 1740. For sure. I wouldn't even consider it until I have it. Now, I keep a published short watch list all the time because you don't ever know when you're going to need it. But until it crosses that barrier, I won't even consider it. Okay. But then back to this little hidden support level I was telling you about. If you look at this thing, you can see where it's just going off of the lows from 1023 onward. And we dipped below it today, but we held it. And then also there's a support level here going back to the May highs. And if you go across here, the market bounced off of that too. So we opened up, we sold off hard. It got a lot of people jittery. Well, there was like 18 points or so on the S&P, and we're heading right back down there as we speak. We're only 3 points off the low, so it's got people nervous. I get that, but you got to step back. You got to step back, and you got to look at what are we dealing with on this daily chart. Okay, the intraday chart, 5 minute, looks horrible on the S&P. It looked like we were going to have a bottom in there. Now we're selling off, okay? But the daily chart's really what you want to be looking at, okay, to gauge where you should be going, because it ignores the whole mess that you see on the intraday charts and just shows you the aggregate of today's action combined with all the other days on the chart. And as you can see, we're still in consolidation, okay? The consolidation goes back to, I think, like 1025 or so, yeah. So going back to this day here, we've just been consolidating the whole time, okay? And we tried to break out today. The bears didn't want it. They sold it off. And so we're just bouncing around, essentially, okay? If we break below 1752, we're outside of that consolidation range, and we're, and things get a little bit more bearish. But like I said, I'm not going to get any shorts until we break below 1740. Whew. All right, enough with that rant. All right, let's look at Twitter, okay? Limited price action. But let's talk about it anyways. I've been sort of going off on it today on Twitter anyways. Okay, I'm going to pull up the 5 minute action. Don't worry about the daily. There's only going to be one bar on there at the end of the day. The daily chart for Twitter really isn't important for at least a month and a half to 2 months. Okay, there's not enough of a price history to be able to use the daily chart on Twitter for at least a couple of months. So start off, and let me tell you, I'm not swing trading Twitter. There's not anything under the sun that I can think of that will make me want to swing trade Twitter and hold it overnight. It's basically, if you hold it tonight, it's like playing earnings, okay? I don't play earnings because I don't know what's going to come about it. So I never hold a stock through earnings. And if you hold Twitter tonight, it's kind of like that because it could gap way up, it could gap way down. I mean, essentially today, the stock gapped up 78%, okay? So if you're trying to keep risk tight, the fact that it could gap down, gap up, gap wherever, 5, 6, 7%, it's not at all an unlikely event, okay? So don't be very good. If you're going to, I can't tell you what to do, or obviously I can't do that, but I would strongly urge you that if you're going to short Twitter or if you're going to go long Twitter overnight, to really think about the risks because it could burn you really bad. And ultimately, trading, the profits that you get on a trade are a direct result of how you manage the trade. So trading's really not about making money. It's what happens. I mean, you want to consistently profit, but it's essentially a result of being good risk managers. If you don't make good risk decisions and manage the risk appropriately on trades, you're not going to make anything in the stock market. It's just, you're going to lose money. You're going to blow up. And people get that, mixed up. They get so involved with, I want to make me some money. And all they do is they shoot themselves in the foot. So don't do that. Consider the risks in Twitter if you're going to hold it overnight. But if you just like charting for the sake of charting and you want to know how should you read the Twitter chart, use for the next few days, I would just, even really for the rest of this week, I would just use like a 5-10 minute chart, okay? Today 5 minutes, maybe tomorrow branch to like the 10-minute chart, and by the end of the week, start using like a 30-minute chart for the week after. And I would probably stick with the 30-minute to an hour chart for the better part of the next couple months, okay? And there will be it'll give you plenty of price history if you want to like swing trade it or whatever. And then after a couple months, you'll have enough price history on the daily chart to make good informed decisions. So, all right, so let's look at some charts that actually have some price history. Facebook. We don't need to look at this through a 1 minute or 5 minute chart. So this one's been bearish since its earnings, man. It broke this trend line, and I felt like that break of the trend line was a huge problem for the stock. It's holding that 50-day moving average like a champ right now. But once that 50-day moving average breaks, oh my gosh, the stock's going to drop, okay? There's no doubt about that, okay? I would put a stop right now somewhere, above 50.93. Ideally, it's too much risk for me, but I would like to be able to put it at 52 and maybe like 52.05. But then you're talking about like 8% risk or so on the trade. So you may have to shorten the risk on that trade. So maybe to like 50.15, which would be about a little over 4%. So overall bearish on the Facebook chart. Groupon. I haven't looked at this stock in a long time. All right, I mean, the one thing that sticks out about Groupon, bearish as well. So you got a downtrend adequately in place. You have a series of lower lows, lower highs, and another set of lower lows, and another lower high. So unless it breaks this downtrend, there's no reason to get bullish on Groupon. Don't buy it. Or as in Kramer would say, don't buy, don't buy. So 890, 895, probably the next testing spot for Groupon. And it's like, except for the 200-day moving average, it's beneath every one of those. Let's look at LNKD and we'll make this the last chart. Wouldn't you know, that one's a little bit bearish too. Alright, see that? Downtrend firmly in place. This is the other thing I'd watch for in LinkedIn, and I think it's already broken it. Nope, sitting right on it, okay? You got some resistance for this candle here, support there, and today it's obviously acting as some support, though it's already broken down below this key support level at one point. If it breaks down any further, that is definitely a good sign to get short on LNKD. So what's the grand theme in all this? LinkedIn, bearish. Groupon, bearish. Facebook, bearish. Okay? What's the conclusion that we should make about Twitter? Okay, I know it gapped up 78% today, and a lot of that's the hoopla over saying, hey, I own Twitter stock on the first day it's trading. They can go to their buddies tonight. They can go to their church. They can go to their, city council meetings. Like, yeah, I picked me up some of that Twitter, TWTR stock today, and they can, sip on their tea and feel pretty special about themselves, and then they get to lose money. So I guess if you're going to brag about yourself and you're willing to spend money on it, I guess no one can fault you for buying Twitter. So don't go buying Twitter. It's bearish, okay? And it's not that I can really tell much from the chart because we don't have a lot of chart to work off of. So you got to look at other names, Twitter or Facebook, Groupon, LinkedIn. And all three of those charts are bearish, guys. I mean, I just mapped it out for you. And there ain't nothing good about them. So that said, I'm going to wrap this up. I do have an excellent book that is now out. Amazon.com, you can get it. Local bookstores, depending on which ones they are, it can be found there. It's called The Part-Time Trader, and it chronicles my life as a trader in corporate America, trading his way out of it, and how I did it, the strategies that I employed, the tools that I used, the lessons learned, how to get by doing it. And it's a great read, and there's plenty of strategies even for full-time traders because I go over all my personal strategies that I even use today. So do that, and if you have any questions, hit me up in the Splash Zone if you're a member. If not, subscribe. It's $59.99 a month, $95 a month, and you make plenty of returns. I mean, Oscar is on fire with his day trades. It can be auto-traded through Ditto trades. Same with my swing trades. So give it a shot. If you have any questions, just email me at ryan@shareplanner.com. That's going to be it for now. Y'all have a great rest of the day, and happy Twitter trading. That's a joke.